let's start from the beginning. I saw 3 questions in a row here, and they're very similar. At least the first 2 were. Let's change gears completely now. We'll come back to this. I know there's some other comments related to this. I just had a question from William about the market sentiment tool and bull puts. We'll get to that in a little bit, but some of our attendees have been waiting for almost 50 minutes here, and they want their questions answered as well. Patrick, in a married put position, sorry here, I just lost track of all that thought here. I'm sorry, what is it, 5:20? Okay, oh, sorry guys. Okay, it's Patrick, my apologies. In a married put, is there ever a reason to exercise a put prior to the option date rather than sell the put and or the stock? Patrick, if and only if the time value of the put is close to 0. Oh, sorry, wrong portfolio. There we go. There's little to no time value left on the put, and you're not getting a fair bid-ask spread. Where's the index? Where's Fabrinet? Oh, shoot. I apologize. I said shoot, so it's okay. What have I got? HDS, the call expired. The put's still there. The stock is at 39.30, 35.70. Okay. Let me do this. I'm sorry. I'm going to manage this real quick. I'm going to close this leg. This is the 70 strike. I'm actually at the 75 for October. It's going to look terrible, but this isn't real. I'll update the numbers later. I rolled that Fabrinet put out to October. Let me add an option leg. So when the stock was up at 74, I think I rolled to the October 75 put. I don't know the price, but I don't really care about the price. 75 put, that's looking exactly where I want it to be almost. Date doesn't matter. Okay, but I'll just put in something. Okay. So Fabrinet is trading at $64. I have a 75 put, which is 11 points in the money. Now, the current price is $11.85 for this option. Okay? So that means, let me go to position analysis. That means I still have, Patrick, some time value remaining on this put, right? We have 85 cents of time premium remaining. So I would look to try to sell to close this put at $11.85, or take a look at the bid-ask spread. And if the bid-ask spread is up to $12.50, I'm going to try to get $12.10. So I'm 11 points almost exactly in the money, and I have 85 cents. So why would I exercise this, even though it's in October, which is only 42 days away? Why would I exercise this and just get 75 back when if I sell to close the stock at 64 and I can sell this at 12, I actually get 76 back? But this isn't as deep in the money as I'd thought. Well, it is deep in the money. Let's go to an option chain very quickly, just for the puts. Okay, and we're going to look just at puts. I'm going to look at all expirations. Maybe the Septembers will give us a good gauge, Patrick. So let's say I was in Fabrinet and I hadn't closed the position yet. There's nothing that's 0. Let me go to a wider chain. Okay. There we go. Oh, there's a negative. All right, so let's say that I had actually rolled up to the 80 strike. Patrick, do you see that? The 80 strike put here for September, and I haven't closed it yet. Now, the market maker's putting in a bid of 13.80 for that put. Well, geez, it's 16 points in the money, right? Our stock's at 64. I would never sell this at 13.80. That's below intrinsic. I'd have to be in... you can't do that. The midpoint is 16. He's being a real jerk about this, isn't he? He's putting the midpoint right at intrinsic value. 0 time premium. Okay, yes, it's 25% in the money with 14 days to go, excuse me. But still, that's rough. And he's got a huge, it's a $5, $4.40 bid-ask spread. That's huge. And our midpoint's right there. No time value. Okay. So in this case, Patrick, to save a commission cost, even though commission is now irrelevant, in the old days, I'd say to save a commission cost, I'd call up my broker and tell him to exercise this put. Because I know, most likely, that if I go in right now and sell to close this put in an order, Patrick, to sell to close this put at 16, the next instant, I'm going to see the bid stay at 1380, and he's going to push the axe price to 1610. He's going to try to force me to get lower than that value. Well, with 14 days left, Patrick, I got two honest choices here. I'm going to put in a bid to close this at maybe 1610 if I do, or 1620. And here's the deal. If it doesn't fill at 1620 or a little bit above time premium, I'm sorry, a little bit above intrinsic, Patrick, a little bit above. If I don't get filled on that, well, 14 days from now, just leave it. I'll leave it go through expiration, and I'll be forced to assign them, right? I'll be forced to exercise the put at 80. If I wanted to get out now and I don't feel confident in this bid-ask spread at all, then absolutely. I'd call my broker or use, if your broker has a link to exercise it, I do that right away. Okay, so that's why I exercise side. Now I'm in the October, remember, the October 75. Yeah, he's got the bid at 1070. That's a little bit below intrinsic, but the midpoint's 1185. I should get, the intrinsic, I'm sorry, is $12, right? I'm sorry, $11. $11. So I should be able to at least get 1150. I'm definitely shooting for midpoint. Honestly, I'm shooting for 12 or 1205 if I'm selling to close this put right now. The reason I'm not selling to close it is because I have a September call at the 75 strike that expires in 14 days. Okay, so I'm just going to let that expire. I should buy it back. I was going to buy it back the other day, but I'll probably buy it back soon and maybe roll out to a call in October just to try to close the position out with no loss on the trade. Right now it's at a 1.8% loss. I'm just going to get it to break even, maybe a little bit more with a bear call spread, but I don't know if the stock's going to recover, so I'm taking a chance here. That's why I want to bulletproof it one more time and just hold it through October as a standard collar position with no risk, hopefully. That's what I'm looking for. Okay, that's why I haven't closed it yet. But again, you see the difference here. $11 intrinsic. Midpoint's 1185. Maybe I can even get 12 for it. Unlikely, but I'll try. But if I just exercise now at 75, I'm only getting 11 back. I'm denying myself 85 cents. Sorry. Which is essentially 1.3% of time premium. If possible, I always want to look to sell to close the put if there's any time value remaining on this position, especially now that commissions are sort of a non-factor. Yeah, Sam adds Ally charges 50 cents for one option contract. One spread would be $1 cost, okay? If not filled, just move on. Yeah, Chuck, that's a good point. I'm sorry, back to yours. Not there. Move on. All right. Kufri, quick question. Is this recorded? Yes. We record all of our Friday sessions and more. I spend part of the weekend and into the week splitting up the webinars into the different sections. And then we post them on YouTube in different sections so that, we'll have the married put section in one video. We'll have the discussion for Edward and likely Chuck in one first block, or maybe I'll probably break those two apart, have Edwards be alone because it was a bit lengthy. And then I'll have Chuck separate with some of the other discussions we're going to get into right now as well. Leads us to Stuart's question. While we're on the married put topics related to the blueprint teachings in radioactive trading. And Stuart says, question on married puts. In an effort reduced to cost of the insurance, we go 6 months out for less theta decay, or 8 months. 5 months is the minimum. So yeah, my average is about 8 months. Okay. You said, would it be advantageous to roll the 6-month options after 3 months to stay off the steep slope of theta decay? Not necessarily, but let's take a look. You said you bought stock at 500 and began selling weekly out of the money covered calls. The stock then systematically declined to 450. Okay, that worked out for you. You continued selling the calls, moving the strike price down as the stock price declined, was making some premium, but then the stock turned around and then you got in trouble. Okay, fairly rapidly shot up. Now you're stuck with the shorter and lower strike calls than your. Oh, wait a minute. I'm sorry. That was ridiculous. I apologize. Stuart, I'm sorry. That I was reading into Fred's question as I was reading yours. It didn't have a line between the two. So, wow. Let's do a married put. Buy 6 months out, 3 months out. So 3 months ago, let's back test. I'm going to go to Smart History Excel. Go back as far as I can. We'll go to July 6th. It's about, well, it's 2 months back really, but let's go to July 6th. Okay. And we're going to look for a 150 day out position, Stuart, that matches our criteria. There we go. Newmont Mining, 61.18, December 65 put, risk of 8.4, a little bit high. Midpoint was 965. Okay, 965. So that's Newmont. NEM, sorry guys, 6165. Oh, 6118, wrong line. 118, July 6, 965. Okay, so I can't add it to the portfolio from the historical, but I'm going to add it right here. Why not? We'll put it into here. Married put. NEM. Sounds like I'm saying anti-M, but it's NEM. Let's change our date to July 6th. 6118. And of course, this stock didn't stay the same price. I mean, that's probably what you'd be looking for. And I said the 65 strike, or was it the, oh, it must have been the 65, absolutely. And that was at 9, oof, hurting here. All right, and we'll go back to July 6th. Not that it matters, but we'll keep it even. All right, so we saw our risk about 8.4% with the midpoint, maybe a little bit less at midpoint. And NEM is right now at 65.35. We've moved up 6.8%, but we've lost a lot of decay, Stuart. You're absolutely right. We're down. The stock has moved up, but we've been in it for 60 days, so we've lost some time premium. We might have gotten in at a higher volatility at this point, why that was so expensive at 965 3 months ago. Actually, it's only 2 months ago, but still, we've lost intrinsic value because the stock has moved up. We have gained time value, though, haven't we? That's funny, isn't it? That's the at-the-money bell curve. I want to illustrate that, Stuart, real fast while we're here, because I think it's always fun to share. When I opened this position at midpoint with a 965 price for the put, and the stock was at 61.18, well, roughly $4 of that was intrinsic value. 583 was the time value of the position, the extrinsic value. That's my true risk, is the time value on the married put position. Okay? Now, we just saw that the stock had moved up to 65. We're trading essentially, this put was in the money by 4 points when we bought it. So we're over here slightly in the money with a time value of 583, or an extrinsic value, I really should say, of 583. 60 days have passed. The stock is now at 65, our at the money strike. And we saw that the closing price right now for our put option is 610. That's interesting, isn't it? Why? Because this whole 610 is what? It's extrinsic value. There is no intrinsic left because the stock's at 65.35. We're 35 cents out of the money. So the extrinsic value actually increased even though time went by because of the at the money bell curve. And we can use that to manipulate the positions. Now, I might use this to manipulate it up to the same December expiration, but go to a higher strike price to try to cut this risk in half. That's income method number 4, one of the 12 income methods available. What Stuart's talking about is saying that now that I'm at this at the money range on my married put, does it make sense to sell to close my December 65 put that only has, a little bit more than 3 months to go? It's close enough to 3 months to go, Stuart. We didn't start at 6 months, but we're close. And then move out another 6 months and stay with the same 65 put, which is only going to be about $8. Well, that's a problem. What am I doing? I'm selling $6 of time premium, $6.10 roughly of time premium, to pay a little bit more than $8 of time premium to gain another 96 days or 100 days. Okay, but what is that going to do to my risk? Well, let me just put this in. Now, the monetary risk, it's going to take it up to 10.8%. I'm still only 180 days out in time. I don't think that's a fair trade-off. I don't think that's the right trade-off. What I would likely do in this case, of course, I still have 90 days to go. I'm not within 2 months to expiration. What I would do is probably income method number 4. I'd wait a little bit more, but I'd sell the 65, by the 70 in the same expiration month. I need to put it in twice. So now, although I'm adding to my cost basis, didn't cut it in half. That's why I'm going to wait longer. I'm going to wait for it to go up a little bit more to maybe 66, maybe 66 and a half, then sell to close my 65, buy to open the 70, get that risk originally at 8% down to 4%. Now, yes, you increased your risk by 2% to gain another 100 days and see less theta decay over the next 60 days or 90 days to December expiration because your put was out to March. I understand that. But I'm also looking at the monetary risk that I now have to cover, increasing it from 8.5% up to the next strike. And would I roll up and out only if this put, and you said, that's not me, I want to roll up and out. Well, in general, if I still have 90 days, 100 days to go, I'm keeping the same expiration at this time. If this December 65 put is under 60 days to expiration or 75 days or less, as discussed directly in the blueprint, in the Exit the RPM chapter, I believe, then I might roll further out. But again, getting a position that's 6 months out in time, staying in it for the first 2 or 3 months, would I roll it and extend it out at that time? No, I usually don't extend it till I'm within 45 days to expiration. I still have 90 days, 100 days to go. I'm keeping the same expiration to keep the cost lower, to keep the risk in control. Let's see, what is this? 350? 355? Okay, let's call it 350. Let's be nice to ourselves. That would be 64.60, right? Yeah, 64.68. Just change the stock price. Now, if I rolled out to March and went up to the 70, this is taking into account the loss we took on the put, remember, the initial put. Oh, I don't want those in there. I'm sorry, guys. Perfect. So it reduces the risk by 1% and gives me an extra 100 days. Not how I approach it. If that matches your goal, Stuart, you can do it. Not how I approach it. At this point, I'm rolling up to the December, but I'm looking to cancel half the risk. That only dropped it by 3%, which is still really good. And now I could sell calls against it to make up that other 5% risk that I lowered it down to by staying in the December month. But I don't think I would extend it out in that sense. That's not how I approach it, worried about the theta decay in that case. Now, when I reach within 60 to 45 days to expiration, that's when, if I'm in a position to roll up and out or position to roll out, I will, if I feel the need to continue the trade. Otherwise, if I've met my goals and I'm with 60 days to expiration, as discussed in the blueprint, Stuart, I'm just closing out the position and I'm going to look to open a new position later on the next week. Another married put that matches the current criteria. Okay. And, this one here, Stuart, the one we just looked at, I do, if it's the right time, I don't mind this going up in strike and out in this case, because we started at 8.4, I believe, with this position, and we took it down to 7.7. Okay, because you had mentioned risk management is job number one, and that's right. But we had taken it down to 7.7%. So you still lowered it by 1% roughly, or 0.7%, and gave yourself another 100 extra days. That's a fair trade-off. But at this point, I'd like, especially if I'm still bullish on the stock over the next 30 days or so, keeping in December in this particular position we started with, lowering the risk down by about 3% from 8.4 to 5.4, and then still having the ability to sell the 70 call for September to maybe knock that down to maybe another 1%, down to 4% risk total to the downside. Might be the move I'd look for. Okay, Sam says on Monday, Robinhood had some problems there. There was something about a fine of $10 million, but I don't know the real story. I haven't seen that or looked that up in that case as well. I haven't seen anything about that. I'm sorry. All right. Okay, first now let me get to Stuart's question, Stuart's other follow-up question from a while ago, back to the married puts a little bit. Stuart says, when you have a married put, what criteria is to decide if you'll roll down or to close the position? It's really based, there's no one answer, Stuart. It's really based on what happened to the stock to pull it down. Was it a market drawdown like today? Or the last 2 days, Stuart, I'm sorry. So I've got that married put on, wow, brain, craft. This isn't right. This isn't, wow, I haven't updated this since I opened it in this webinar portfolio, I guess. Okay. I'm currently holding the 37.50 strike on Kraft Heinz, and I'm bulletproof by 4%. Pretty sure that's accurate. It's 4. Yeah, I'm pretty sure it's 4%. So let's just say KHC, add stock 100 shares. And I'm just using this as an example. Cost basis is much lower than that, I believe. But anyway, so January 37.50 put, and at the time I bought this, the stock was at 37. So 37.50 would be 340. So let's call it 3. Okay. Okay, fine too. Sorry, folks. All right. So anyway, total investment 36.10. That's close enough. 37.50 strike put. It's at 140. The stock's at 33.47. Stuart, what can I do with this married put right now, following the rules in the blueprint? I can't sell a call at 35. I don't want to sell a call below the put strike price. This might actually take me out of bulletproof status and give me risk to the upside if Kraft comes back. Kraft, of course, this put expires in January. So I have two choices here. I can liquidate the position now and get a little bit more than 3.9% return. About a 4.3, 4.4, I believe, is liquidation profit. And 4.1%, I think, is the put option at expiration if the stock stays below 37.50. And this is about where I am. And so what I'm looking at here now, Stuart, is it's down below there. I've got to wait for it to come back up to 37.50. Why is the stock fallen from $36.80, $37 down to $34? Well, one problem was the dividend payment. It's not high, but the dividend did come out at the end of August. So, that day it dropped down to 35.40 cents or whatever it was. And then what happened to every other stock in the market? And before that, it had pulled back a little bit due to some expected weakness as well, but now it's down to 33.47. Kraft is not going to disappear. They're going to struggle with every other company with the unknown due to what's happening with everything with unemployment, the U.S. economy, other world economies, coronavirus in our economy and other economies and countries, as well as be affected potentially by the election. But in my mind, I still have 109 days to go. Is it 96 or 109? I can't remember the number we looked at. Oh, it's 133. I was thinking December was the 109. Okay, so I have 133 days to expiration in this case. And I'm still positive and comfortable with this stock. It's not going to gain 20%. I know that in 36 days. I could take my money out of this and find a more drastic moving stock. But in an uncertain market where it looks like we might have started a pullback, it's something that is more of a staple stock that I'm comfortable in staying in. So even though I'm bulletproof right now, Stuart, rather than close this for whatever my liquidation is, 4.2, 4.4%, whatever I said, I'm tempted, and these aren't my actual prices, but it's close because the bulletproof, I'm considering rolling this down to lower the cost basis a little bit by going back down to the January 35 put, staying 130 days out in time, still keeping a bulletproof status, but now being able to manage more effectively closer to the price. I've lowered my effective cost basis on the position. I'm still bulletproof. We'll collect another dividend in November, and I can do other income methods closer to the 35 strike because I think this stock will recover. And even if it drops down to 32, as things hopefully start to get better, both in unemployment across the globe and COVID-19 issues across the globe, this will gradually recover. It's not a rocket ship. It's not a Tesla in the great days. It's not an Apple over the last 2 months. It's nothing like that. It's Kraft Heinz. William jokes, people are cutting back on their ketchup consumption on these uncertain times. Yeah. But they've been doing extraordinarily well. Okay. So the idea is that if my expectation is that this is a stock that's going to be able to stay in the market, be primed in the market, and still be set to do well, I'm not concerned about closing it right now because how many other stocks am I comfortable getting into? There's actually 2 or 3 that I was looking at today. You had mentioned NEM. We had looked at that a little bit earlier. In addition to NEM, you had also mentioned, I apologize, the other stock that you had in there too for recent trade. I was looking at SailPoint today, which looked pretty good for married put position in that case as well. So to me, it's about the expectation and the time remaining. To be honest with you, if I had held it this long, Stuart, and the Kraft Heinz position was bulletproof to that 4% or 3.9%, and this was an October put, and the stock's at 33, I'm not worried about managing this. I'm probably just closing out the position. You're right. Too short of a time frame, too uncertain to see if I want to manage it going forward, knowing that this isn't really a giant move income strategy. This is a more growth. But if I've been in it for 6 months already, I'm coming up to expiration in 45 days, 60 days. It's well below my put strike price. I don't want to lower the put to October to increase the risk because I don't have enough time to get the money back. I'm likely liquidating it. But with 133 days still to go, I'm tempted to roll this one down. Oh, JPM, okay. I'm tempted to roll this one down in price, the strike price, roll the put down, lower my cost basis, take on a little bit extra risk, which takes me out of the 4% bulletproof status, but still have that higher expectation going forward. And yes, collecting another dividend down the line in November because I just crossed the ex-dividend date at the end of August as well. And I haven't accounted for, I haven't accounted for that in this calculation either. So it's actually probably closer to a 4.8% bulletproof status. I'm sorry, 4.8% liquidation, 4.4% bulletproof status at this point. And yeah, why not hold it on and continue? But yeah, if I'm close enough, like I am with Fabrinet, the only reason why I haven't closed the Fabrinet position yet, which has the put expiring in October, is because I have that short call that expires in September. And it's not at 80% profit yet. It was close at one point, but it didn't reach 80% profit yet. When it reaches 80, 85% of the max profit I expect on that Fabrinet 70 strike call I believe I have, I'm probably going to buy to close it, likely sell to close the put and the stock, and get out for a wash. Maybe a little gain, but the stock is below what I purchased for it. Stuart said, real quick, is there a difference between PowerOpt and RadioActive? Yes. PowerOptions is, as you can see, a suite of tools, Stuart, for self-directed options investors, and we support over 23 of the different option strategies. Search tools, analysis tools, portfolio tools for tracking and managing your positions, as well as a virtual library of archived webinars on using the tools, the different option strategies, naked puts, long puts, concepts on credit and debit spreads, poor man's covered call, i.e. diagonal spreads, iron condors, a lot of education as well. The RadioActive Trading website is based solely on the married put concept talked about in the blueprint. Okay, this just deals with the married put positions, the concepts discussed in the blueprint, and the 12 different income methods. A Fusion subscriber at RadioActive. I'm so sorry. So sorry about that, Stuart. There we go. Ha. All right. And so the Fusion subscription deals just with the married puts and the concepts of the blueprint. Okay. And a Fusion subscriber, it double clicked on that, didn't it? Okay, there we go. All right. So a Fusion subscriber will get access to what's called the Fusion lessons, which are timed lessons to help investors get more familiar and master the techniques in the blueprint. The Open Trades Trade Tracker is where I've talked about the, I was way off. I'm sorry. I am bulletproof 4.1% on Kraft Heinz. It's a 7.7% liquidation value right now. And I closed the other position, KDS, for a profit, KDH, for a profit. So that's why I'm looking to open new positions because I only have 3 opens now, Stuart. But anytime Ernie and I place a trade or do an income method on one of our open trades, now you got me confused. Fusion subscribers will receive an email directly with the trade. They can choose to follow it in that case or do others. You see, Ernie's got 2 positions of about the 6 he has open. 2 positions are bulletproof of the 6 or 7 he has open. This one was just open this week, so it doesn't really have any adjustments done to it in that case. So you have access to the open trades, the basic search that, yes, there's still the married put screen on PowerOptions for searching. But here on Fusion, you also have an RPM report as well. for those, and then a stock insurance tool and members-only white papers and webinars as well. This is what's at radioactivetrading.com, the Fusion subscription here, and Blueprint owners can also access their members-only webinars and other information as you're a Blueprint owner. Okay, so that's just the difference between the two. This is more further education into the married put concepts. It doesn't include the other strategies, whereas Power Options is that suite of tools for sort of self-directed options investors, 23 different strategies, patented search tools, analysis tools, and more. All right, so that's the difference there, Stuart. And if I can find a better presentation that discusses the difference, I think there's one on RadioActive Trading for Blueprint owners and Fusion subscribers that describes it in depth and how to use Fusion, start using it. I'll try to look for that for you as well.